Right, good afternoon. Our clients have now joined us. So this morning we had a session with some of our investment team and the financial advisors. So if you're a client, you would have joined us on Zoom now. Just a couple of things about the presentation today. If you have any questions that you would like to ask, please type them in the comments box. We will try to get to them during the presentation. All right. If we don't, we can answer the questions after the fact. There's no CPD points for clients. Just a few things about the presentation today. We're going to have two presenters talking to you today. The first is Monine Watson, who you would have met hopefully last year when we were doing this live around the country. She's our Chief Investment Officer. She's going to be unpacking fund performance. She's going to be talking about the markets, very, very good markets last year. So Manine's going to be talking about that. And then we're going to be crossing to our investment strategist, Isak Odendaal, and he's going to really unpack what's been happening in the economy. And we've got some really interesting snippets about South Africa and whether we believe that South Africa is headed the same way as Zimbabwe, and we did a lot of work on that. So we look forward to hosting you for approximately the next hour or so. Yes, and thank you very much for your attendance.
Welcome to Investment Update for 2021. COVID-19 pandemic will define 2020 forever in our minds. When we were face-to-face about this time last year, the coronavirus was becoming a real issue within the Asian region. Many viruses before this had been contained to that region, and that was the expectation by many. But looking back with a year of hindsight, we actually know that China and Asia has come through this crisis a lot stronger. And if one looks at the picture in the bottom right-hand corner, that was taken in October last year with tourists back at the Great Wall in China. So life there had pretty much returned to normal, while in the rest of the world we were still struggling to contain the virus with associated lockdowns and pressure on the healthcare system. Our lives become very different. We have become accustomed, I don't know if accustomed, but have enforced social distancing and wearing of masks. And as we know today, we're doing this from home or from much smaller venues or private offices. If we look at the disruption that was caused to people's lives, jobs and businesses last year, it's amazing how strongly markets have come through this. The vaccine obviously gives us hope of a return to normal, and until we get there, governments have supported economies and jobs. So if we just look at what happened last year, the chart shows the key asset classes that we are invested in rands. And one can see the big dip in performance in March last year, in the heart of the crisis, but how quickly markets have recovered from there. As we said, supported by rate cuts and fiscal support, mainly in developed markets. So the strongest performing asset class was global equity in the red line, and then followed by global bonds in black. Global bonds proved very defensive in the middle of the crisis, but have given back some of those gains. But amazing to see that global equity has given you about 20% in rands over the last year. The strongest performing asset class locally was bonds. Surprising when we had a downgrade, and not just the downgrade, but the impact that the crisis has had on our debt position. But the All Bond Index, ended the year about 9% stronger. South African equities in the purple line took a bit longer to recover, but were back in the black just by the end of the year. The asset class that has really struggled the most has been property. The yellow line is global property. The sector globally has a lot more diversification than what we see locally, many more sectors outside of retail and office. And our managers were able to take advantage of that. And in rand terms, our global property building block actually ended slightly in the positive last year. But where the brunt of the pain has been felt has been in local property. South Africa very exposed to work from home, as well as the impact that lockdowns have had on the retail sector. So how were we positioned through the course of last year? We had a neutral exposure to equity. So going into the crisis, that hurt performance, but having an overweight to offshore versus local mitigated some of this volatility. We've maintained a full weight to offshore. We have favored global equity and had a neutral position in property and no exposure to global bonds. Clearly, global shares, as we showed in the previous graph, performed very well on a relative basis through the crisis, and we used that opportunity of strength to rebalance back into South African asset classes. Locally, we have favored fixed income over equity and had a very low exposure to property within our property building block. Clearly, we still had property via our equity building block and within our flexible fixed income mandate. But if we look at last year as a whole, there was a lot of uncertainty and a lot of volatility. And we have, our main objective has been to keep the portfolios diversified. We've done that by maintaining offshore equity exposure. Clearly, global markets have had much greater support from their respective governments than it's been the case in South Africa. But that offshore exposure has been balanced with much cheaper asset exposure in South Africa via bonds and equity. If we bring this together, we look at performance over the last year and longer period, how have the funds done? We have divided our funds into three broad categories. In the dark green at the bottom is the lower return strategies, and then the green above that is our typical balanced fund, targeting inflation of between 3 and 6%. And then lastly, at the top, we have our unconstrained portfolios. So we're firstly going to look at the SIS range of funds. If one looks at the black bars, which are inflation, then over the last year, all of the strategies have achieved returns quite materially in excess of inflation. With the max return fund, which had a very large exposure to global equity, doing particularly well. But in previous years, we've seen our balanced funds struggle, and one can see that this year, they've achieved in region of 7 to 8%, about 5% ahead of inflation. What is pleasing is to see the returns over the last 2 years, also materially ahead of inflation. But if we look at the 3-year number, barring the low return funds and max return, it's still been challenging to meet our real return targets, with the balanced funds still below inflation, but we have started to see those numbers improve. Over the long term, the strategies are still achieving decent real returns for investors. If we turn to the Old Mutual multi-managers range of funds, the picture is very similar in terms of the real returns that have been achieved over the last year as well as the last 2 years, with the 3 and the 5-year returns remaining challenging for the balanced funds. But as we've seen an improvement in equity markets, we hope to see those numbers also start to improve. So how have we done in terms of managing the funds? We always assess our performance both in terms of tactical asset allocation and manager selection. And one can see again that the tactical positioning of the fund has added value over the last year, and that has mainly come from the overweight to global equity as well as the overweight to South African fixed income. We spoke at length last year about changes we had made from a manager perspective in 2019. Those changes have worked very well for us in 2020, with no further changes being made on a manager level. So how have we done from a manager selection value add point of view? As you can see, this chart can be very volatile from year to year, but over the last year, our managers on aggregate have done very well, and that has boosted returns in the strategies as well. So lastly, I want to end off by looking at the peer relative performance. We manage these funds to deliver real returns for clients. We don't aim to beat the peer group. We're trying to deliver on the fund objective. But it's always worthwhile seeing whether we have done a good job versus our peers. So if we look at the low multi-asset, low equity category, here we have the SIS Inflation Plus 1 to 3 fund and the Old Mutual Multi-Manager Cautious Fund of Funds. Both funds have delivered top quartile performance over the last year, and over the last 3 years are in the top half. Over periods longer than that, the fund's performance has also been very competitive, being in the top quartile over all of those periods. The Old Mutual Multi-Managers Defensive Fund of Funds is in the multi-asset medium equity category. This fund has also achieved top quartile performance over the last year. Over the last 3 years, just in the top half, and over longer periods, also producing a competitive outcome versus its peer group. Then all of our balanced funds sit within the multi-asset high equity category. For the year, they bunched around the top of the second quartile, bottom of the first quartile. So again, a good outcome for clients versus peers. We had a tough 2018, which is still sitting in the 3-year number, but we can see the improvement we've had over the last 3 years, and hope and expect that number or that ranking to improve going forward. Over a 5-year period, the balanced and SIS 3 to 5 fund have done slightly better than the more aggressive balanced and SIS 4 to 6 funds. Over 7 and 10 years, the funds have maintained a competitive positioning. I just lastly want to speak to our SIS global range of funds. These were merged into our UCITS funds during the last quarter of last year. They continue to be managed in the same way. Returns have been strong over all periods versus inflation. For the Inflation Plus 3 to 5 fund, that has also been the case, particularly given the strong performance that we have seen from global equity over the last year. And then lastly, for the SIS Global Inflation Plus 5 to 7 fund, this fund is also ahead of its inflation plus target over all periods. So the question on investors' minds is, can the real gains continue? We've seen much stronger returns over the last 2 years after a very weak 2018. And the question is, can we continue expecting improved performance on a real basis from the strategies? We have an integrated investment process which combines strategic asset allocation, tactical asset allocation, and manager selection. Last year, we spoke at length about tactical asset allocation and manager selection. Today, I want to focus on strategic asset allocation because that is at the core of what we do and speaks to the achievement of real returns going forward. Our tactical asset allocation is forward-looking, trying to assess the environment and the valuation of asset classes. Our strategic asset allocation process is backward-looking, where we assess what asset classes have delivered in real terms over the longest history. We also look at the risk and volatility of each asset class, as well as how it is correlated to other asset classes. This chart shows the real returns that have been achieved by asset classes over their longest history. So if you look at the bar on the left-hand side, South African equity has delivered a real return of over 7% over the longest history we have for that asset class. Bonds has delivered just over 2%. We then look at the bars on the right-hand side. Those are for the global asset classes. The blue caps on the bars are the 1% that the currency has depreciated by in excess of the inflation differential between ourselves and developed markets. So if we just look at the green bar of global equity, real returns have been in the order of 5.5% over time. These real returns, together with the risk of each asset class and the correlation between asset classes, are what goes into our strategic asset allocation modeling process. What that delivers is an optimal portfolio that meets the specific real return target. It's essentially the starting point in managing each of the real return strategies. So the question is, what have asset classes actually delivered in real terms over the recent past? In this chart, we have the real returns for each of the asset classes named at the bottom of the chart over 5, 10, 15, and 20 years. So if we start on the right-hand side with global bonds, here we have an expected real return of just under 2%. Over a 15 and 20-year period, bonds have disappointed in terms of achieving that real return. But in the last 5 years, as yields have moved lower, bonds have done very well and exceeded that expectation. If we move on to global equity, as I said, we expect a real return in the order of 5.5% over time. Over the 20-year period, the light green bar, global equity has delivered 4% real. If we remember where we were in 2000, that was the middle of the dot-com bubble, so valuations were clearly expensive. But over the long period, even starting with an expensive valuation, you've still had a 4% real outcome. But if one looks at the last 5 and 10 years, global equity has far exceeded our real return expectations. And this has largely been on the back of a technology boom, which has seen incredibly strong earnings from a sector of the market. Moving on to South African asset classes, we've had real returns in cash in South Africa over the last 20 years, and so cash has delivered decent real returns over all periods. Bonds have also done incredibly well over 5, 10, 15, and 20 years versus our expected real return assumptions. If we then turn to SA equity, and look at returns over the last 20 years, then that real return target has largely been achieved. The disappointment has come through in the shorter term, where over 5 years, equity has actually delivered a negative real outcome, meaning that returns over 10 and 15 years have also been pulled lower. So the question is, can the historic returns that have been delivered by SA equity be replicated going forward? We did some work to understand where that 7% real return has come from. And it hasn't come from above average GDP growth, but rather the profitability of the companies listed on our market. Recent very low growth in our economy has, however, dampened profitability. This has been exacerbated by poor capital allocation across some companies. But the real question is, if growth can improve from here, can companies improve their profitability? If we look at the South African market over the last 5 years, and particularly the capped SWIX index, only about a third of companies have delivered positive returns over that period. Only a third, with the median return being in the order of minus 20%. So where you sit today, ratings and earning bases are very, very low, already pricing in a lot of the negativity that people feel around growth in South Africa. If we look at our market, it is also about more than domestic companies. We have many global companies listed on our market, as well as mining companies that benefit from external growth. And we've seen how these two sectors have supported growth during a very volatile time in 2020. And then looking at global equity, as we said 20 years ago, we started with an expensive rating, which has meant that that real return target wasn't achieved over that whole 20-year period. But having global equity having returned much better, or given us much better returns over a 10 to 15-year basis. Where we stand today, valuations look pricey. as markets have run ahead, expecting a recovery in earnings, as we see a recovery in the global economy, coming through this year and into next year. The question is, will earnings growth justify the current valuation? The way we look at global equity is always in terms of diversification. So we diversify our exposure to the sector across different styles, and we know that value, as a style, value companies have struggled not just during last year, but for a number of years, lagging the technology and growth type companies. We also have an exposure to emerging markets, which have done well through the course of last year, diversifying some of the exposure away from the US, which looks particularly expensive on rating multiples currently. So looking forward, what is the economic backdrop for the asset classes that we invest in? As we know, last year was a tough year, with the global economy contracting by more than 4%, but the IMF forecasts that we will have growth and a recovery in growth of 5% in 2021. The global economy is set to recover this year. The pandemic is still raging, but vaccines bring hope that we can have a return to normal at some point, hopefully during the course of this year. A lot has been done to support individuals and businesses, and this is mainly to prevent scarring, where you have a permanent loss of jobs and a permanent impact on investors and individuals' level of confidence. So we've seen a lot of spending by governments, and we've seen central banks cut rates to ultra-low levels. In the US, we've come through I was going to say peaceful, but it was a tumultuous US election. But we have a new administration in office. They are determined to continue the support for the economy that we've seen so far. The key question is whether this administration will be able to push through some of the spending on infrastructure that has been spoken about so often in the US economy. China's come through this crisis strongly and provided some kind of support for global growth through the course of 2020. So while there are risks and there still remains uncertainty around the virus, our base case is that we will see a recovery from here. The question is, as economies recover, will inflation become a problem? Central banks have said that they will only raise interest rates when inflation is consistently above the 2% level. So what are the risks? There's been a lot of stimulus and support that has gone into economies. There's a question of whether further spending in the economy will push up inflation, but that isn't a problem for today. Our view is that inflation should remain contained. The forces that were keeping inflation lower prior to the crisis remain in place. Debt has increased dramatically as governments have supported economies through this crisis. With interest rates low, we think that this is probably not a problem for the immediate future, but is something we will definitely be monitoring as an investment team. If we move our focus to the local economy, we can see the devastating impact that the COVID-19 pandemic has had on growth in South Africa. Forecasts were for growth to be 8% lower in 2020. That's probably going to end up at about 7% lower. But a massive fall in the GDP of our economy, with growth next year forecast to be in the order of 3.5%. And one can see from that it's going to take us some time to get back to pre-pandemic levels. So what is the outlook for the next 5 years? While we get very negative about South Africa, there have been some very positive developments. China's come through this crisis much better than the rest of the world, and we've seen commodity prices not just hold up, but also increase over the last year. That has been very good for our miners, and we've seen it in the strength of the currency in the latter part of this year. Another positive is that the Reserve Bank has been able to cut interest rates aggressively. Inflation is expected to stay in the target range in the medium term, and we can expect interest rates to remain at low levels. This is also supported by an external environment where globally central banks are also keeping rates low. And then we've had some things that have really been tough in terms of growth over the last 5 years. We've had drought, load shedding, and a slowness in policy reform. Many of those things are starting to turn the corner. What we haven't yet seen is progress on confidence levels, both at an individual and business level. But as we see things starting to improve, this could be a real game changer going forward. But probably the most important thing for South Africa is that we have a supportive global environment. That has really been the case through this crisis, and that will ultimately support growth in South Africa as well as the performance of the underlying asset classes. So if we look at the different investments within a South African context, cash is no longer offering the good real yields that it was, given the cut we've had in interest rates. But government bonds are offering attractive real yields in the order of 10 to 11% in longer dated bonds, as our market prices in the fragility of debt and growth in South Africa. But on a real basis, bonds can still deliver very decent real returns for investors going forward. Equity, as I said, is coming off a very low base, supported by valuation. We have a diversified market. Domestic companies have been challenged in the last 5 years, but that base is low. We have a large global contingent of our market that has so far been supported by global growth, and we believe will continue to be. The environment for property remains challenging. Yields are high, reflecting these challenges, but leverage in the sector is also high and presents a risk, and we have remained underweight to that asset class. So bringing that together, how are we positioned? This chart gives an indication of valuation across the different asset classes that we are invested in. The red dots are the expected real returns that I have been speaking about, and the bars indicate current valuation. If we look at the right-hand side of the chart, global asset classes are looking more expensive, in particular global bonds. Global property is fairly valued, and global equity slightly expensive. If one looks at the left-hand side of the chart, however, excluding cash, the picture is very different, where local asset classes are offering a lot more value. This pricing reflects the negativity and pessimism that people have towards growth in South Africa and the ability of companies to generate earnings in this environment, as well as skepticism around our ability to rein in our debt. But this just means that these asset classes are already reflecting a lot of what we know. So taking this valuation into account, we haven't made many big changes in the funds over the last year. We have maintained a neutral exposure to equity with an overweight to global equity versus South African equity. Within the local space, we still prefer South African bonds, given the real yields that are on offer. We still have a very low exposure to SA property, given the leverage risks in that sector. Globally, most of our position is in global equity. We have no exposure to global fixed income, and we are neutral on global property. So in conclusion, there's a big opportunity in South African assets. This, of course, comes with lots of risks. We know this, we live here, but we are coming off a very poor last 5 years, and many of the problems that South Africa has faced are slowly being fixed. Markets have rallied very strongly in the last 3 months in particular. I think our equity market is up in the order of about 20% since the end of November. We know that equity is not like cash. It doesn't go up in a straight line, so one can expect volatility from here. And to get the real returns that investors need, it means you need to have a longer term horizon. As an investment team, we aim to build diversified portfolios, taking account of valuation and risk. So our message today is one of staying invested. As Charlie Munger said, the big money is not in the buying or selling. We can't time the markets, and it's about being patiently invested to achieve the real return targets that are needed. Thank you very much.
So recently you would have read a lot about this idea that South Africa is turning into a failed state. And that's obviously quite alarming, both as citizens and as investors. But this concept of state failure doesn't have a single definition. And therefore, I think some of the commentary around this could be exaggerated. But I'd like to present a simple framework for us to look at this issue and try and make our investment decisions not based on emotions, but on the facts. So let's step back for a second and ask, why do we have a state? The philosopher Thomas Hobbes in 1651 wrote this book called Leviathan shortly after the English Civil War. And what he warned against was this idea of anarchy, that in his words there would be a war of all against all without the presence of a Leviathan, a strong state to keep the peace. And importantly, he said that people would submit themselves to this Leviathan, that people would submit themselves to the state. In other words, there's a relationship between the state and its people. Now, clearly, since then, our thinking about states has evolved. We now expect states to deliver a whole range of public goods and services, health, education, infrastructure, and so on. And therefore, when you're thinking about state failure, it is the idea that the state is either unwilling or unable to deliver those goods and services to its citizens. So a simple example would be a civil war, as we've seen recently in Libya and Syria. It could also be the case of rapacious elites trying to squeeze the last drop of blood from a collapsing economy, as we've seen in Venezuela or Zimbabwe, just across the border. These kind of things don't happen out of nowhere. Civil wars don't appear out of nowhere. So we need to dig a little bit deeper and understand the underlying institutional makeup of states to gauge what the true risks of state failure are. So this is where I'd like to present a very simple model. Some of the best scholarly work recently has come from these two economists, Ajemoglu and Robinson. And you can see they've actually written a book about state failure. But their model has this sort of two simple axes. The one is the strength of the state. Obviously, you need a strong, capable state to keep the peace, to prevent anarchy, to prevent the war of all against all. But at the same time, on the bottom axis, you also need a strong society to push back against overreach from the state, to push back against abuse and exploitation from the elites who run the state. And when these two factors are not only in balance, but they're actually pushing each other forward. In other words, the stronger the society gets, the stronger the state gets, and the stronger the state gets, the stronger society gets. Then you move into what they call the narrow corridor. And when you're in this narrow corridor, that is when you not only have peace, but you also have prosperity. Economies can develop, wealth creation can take place. And that is the process that we've seen in the rich countries over the last 2 or 3 centuries. So to use a couple of examples of different countries, I mean, North Korea is an obvious case of where you have 100% state and 0% society. Kim is the only leader there, and what he says goes. On the other hand, famously, Somalia, last 3 decades, there has not been a functioning government. and you essentially have a case where you have different tribes, different clans running the show. Clearly, Somalia is neither peaceful nor prosperous. So, you don't want the complete absence of the state either. And then the other extreme, you have today's rich and successful countries, Europe, North America, and as I've shown you, Australia, where you have a strong, capable state that can provide all these goods and services, that can support wealth creation, that can support economic growth, but the state is held accountable by society, and the rights of individuals are protected, and it is a very peaceful and prosperous place to live. So where does South Africa fit into this model? According to Ajamodlu and Robinson, South Africa moved into this narrow corridor in 1994. In other words, when the strength of the state was finally balanced by a more democratic society, and the institutions that hold the state in check are now a lot stronger than used to be. So we're in the corridor. That doesn't guarantee economic growth. That doesn't guarantee wealth creation. That is a discussion for another day. But the important point here is that it also means we are not going to collapse. So as long as that you have that balance between the strength of the state and the strength of society, you are very unlikely to end up as a complete failed state. So let's look at some of those institutions that are meant to balance the power of the state in South Africa. I've just shown a couple of examples here. You've got obviously a free press, you've got civil society, NGOs, you've got think tanks, you've got independent judiciary, you've got strong universities, trade unions, and importantly, you've got political contestations. We have regular elections, free and fair elections, and even within the ANC, there's a lot of competition, and you've had various factions vying for power, and that kind of competition, while it creates noise and uncertainty, that is also ultimately the lifeblood of democracy. There's that competition and that contestation that prevents one group from taking over and ending up in a Zimbabwe-style situation. And then maybe there's a slightly counterintuitive way of looking at this, and that is to say, let's look at tax revenues. Now, most of us don't actually like paying taxes, but I don't think we understand the importance of it in this balance between state and society. Now, first of all, obviously the government needs to fund itself. So the first sign of problems is when the government is unable to fund itself through tax revenues, and then it has to resort to either theft or looting or large-scale borrowing. Now, we know that South Africa does have quite high debt levels, but by and large, the government funds itself through tax revenue, and in this chart you can see over time, in real terms, tax revenues have grown. Clearly, there are cycles, and the most recent recession, tax revenues fell quite sharply. They will pick up again as the economy picks up again. But there's a second, as I said, counterintuitive way of thinking about this, and that is that if a state depends on its people to fund itself through tax revenues, then there is a contract between the state and the people. And this goes all the way back to 1215 when the barons in England forced King John to sign the Magna Carta. And this idea was that you will only, as king, you will only raise taxes with our consent as the people. So this is a very strong link between a government and its citizens. And this is one of the big warning flags. If you're talking about state failure, when the ability of the state to raise taxes and the willingness of people to pay taxes starts to fall apart. So how does South Africa compare to other countries? Now, there's a whole range of indicators, a lot of think tanks, universities, global organizations try and quantify these kind of issues, and they rank states. So I'm just going to show you a couple, but as I said, there are dozens and dozens of these indicators. The broad message you'll get is that South Africa sits in the middle. We are neither the best nor the worst. We sit with our peer group of other emerging markets, Turkey, Argentina, Brazil, India, Indonesia, etc. And I think a lot of the failed state narrative comes from the expectation that South Africa should be like an Australia or a Canada or a UK, because most of us have friends or family that live in those places. But that is not a realistic comparison. Within our peer group, we actually fare pretty well. So the first one is just a rule of law indicator from the World Bank. And you can see a country like Australia sits right at the top of that indicator, as you would expect. A country like Zimbabwe sits right at the bottom of that indicator, as you would expect. And South Africa, again, sits nicely with our peer group of India and Brazil. So again, neither the best nor the worst, but more or less as you would expect, and more or less stable over time. Second indicator is one from the Fund for Peace, and this looks at state fragility. So again, this is a kind of a warning sign for that failed state idea. In this instance, you want to be at the bottom where Australia is. It's obviously a very robust state. There's no question marks over Australia falling apart, but a country like Zimbabwe is sitting right at the top there. And here again, South Africa, in terms of state fragility, measures very closely to our peers, India and Brazil, and other similar emerging markets. Then if we look at economic freedom, this is from the Heritage Foundation. This indicator captures things like property rights, very important. No one is going to invest or innovate if they don't have property rights, if they don't think that they will benefit from that activity. It includes things like taxation. It includes things like government involvement in the economy, over-regulation, and so on. And here again, typically the richer countries sit at the top of this index. The richer you are, the more economic freedom you have, and the more economic freedom you have, typically the richer you are. So there's a very strong link between those things. So Australia is sitting right at the top there. Zimbabwe, you can see the deterioration. You can see when the land invasion started taking place in 2000, and then hyperinflation, and a very strong collapse in this economic freedom ranking. South Africa, once again, kind of in the middle. And in this indicator, we're actually a bit better than our peer group, a bit better than India and Brazil. And then finally, corruption, because I think the corruption story is a big part of why we have this failed state narrative. So just on corruption, a reminder that it's not a good thing, obviously. But corruption does not prevent economic growth. And some of the fastest growing economies on earth, particularly if you look at India and China, these are also very, very corrupt societies and corrupt states. Okay, so that by itself does not preclude economic growth. But if we look at this chart, as we will see, Zimbabwe sits right at the bottom. Again, you have a very corrupt elite, and I think for the broader society, it really is a matter of survival. Again, a country like Australia sitting right at the top. Not much corruption there. South Africa, again, in line with our peer group. In fact, slightly better again than Brazil and India. And I've included Russia here on this particular chart, very close to the bottom, close to Zimbabwe, just to illustrate the point that corruption is not an African phenomenon. So hopefully, what that shows is, that we are probably not as bad as you would imagine in terms of our international rankings. We're not the best, we're not the worst, we're sitting in the middle, and there's no real sign of things fundamentally deteriorating. And then the last question is, are there any signs of improvement? And this particularly ties in, obviously, to our investment case and our expectation for asset class returns, because clearly you need a stronger economic performance for those assets to also perform. So maybe just take a step back and ask, why was the economy in such bad shape over the last while? Clearly, 2020 was a COVID story. That wasn't our fault. That was an external shock. But the 5 or so years prior to 2020, we also had very disappointing economic growth. In fact, for that whole 5-year period, we averaged at about 0.5%, which is way below our long-term economic growth rate. And I think there are, broadly speaking, 5 factors. The one was the decline in commodity prices from 2011 to 2015. South Africa is still a mining export country. Commodities have a big influence, not just on the mining sector, but it has ripple impacts across the entire economy. Secondly, we had rising interest rates, not just in South Africa, but also, importantly, in the US. So you have a global environment where capital was pulled out of emerging markets, including South Africa. This led to higher interest rates That obviously squeezes the domestic consumer. Droughts, I mean, agriculture is not a big sector in South Africa anymore, but droughts, we had massive droughts in the north part of the country, also in the Western Cape over that period, and this leads to higher food prices. It puts tremendous pressure on consumers. Load shedding, I don't need to explain to anyone that you can't really run a modern economy without reliable power supply, so this has been a big headwind. And then the last point is around policy uncertainty, political uncertainty. Businesses can deal with corruption, businesses can deal with laws they don't like, they can deal with regulations they don't like. What they struggle to deal with is uncertainty. What they struggle to deal with is when the goalposts are continuously shifting, when you don't know who's going to be in charge and what they're going to do once they are in charge. And that is pretty much sums up the story of the last 5 years. So if we look at each of these factors in turn, have things improved? Are things improving? In terms of the commodity prices, it really has been remarkable, the pickup in commodity prices over the last year. This is an index of our biggest commodity exports. In dollar terms, you'll see the massive decline from 2011 all the way down to 2015. And then over the last year or so, you've seen a very, very nice improvement in commodity prices. This helps the rand, it helps the JSE, it helps government's tax revenues, it helps employment, it helps investment. This is a big deal for our economy. If you look at interest rates, clearly these have come down. You can see that between 2013 and 2016, the Reserve Bank was hiking interest rates, despite the fact that inflation wasn't out of control, but the COVID pandemic and low global rates have given them the excuse and the cover to actually cut rates quite aggressively. And as we know from economic textbooks, it takes about 1 year to 2 years for the impact of low interest rates to really filter through to the economy. So that is going to be a support for the next while. Then electricity. I mean, I'm not going to try and predict when load shedding will come to an end because there's a high degree of unreliability there. But what we do know is that there's going to be massive investment in energy and particularly renewable energy over the next couple of years. So the current installed renewable energy capacity in South Africa is about 4,500 megawatts. That is set to grow to 26,000 by 2030. So that's going to lead to massive, massive investment in this sector, cleaner, greener, hopefully cheaper energy and hopefully reliable energy. And that's going to be a big difference for our economy. And on the politics side, look, I think the political situation will continue to be noisy, it will continue to be uncertain. But what we have seen is that some of these key institutions, key government institutions, you've seen quite strong improvement. And I think the important one, as I highlighted earlier, was in terms of tax revenue. So the cleanup at SARS is very important. The cleanup at the prosecuting authority, very important. There's been a good turnaround at Eskom. And then, that is obviously the most important SOE for our country. So again, I don't think politics is going to become quieter or calmer, but I think it's going to have a less destabilizing impact on our economy. And I think underlying, you're seeing important improvements in governance and in our institutions. I mean, what I'm not showing you here is, unfortunately, at the municipal level, you're still seeing dysfunction in many individual municipalities, and there's still a lot of work that needs to be done there. So just to conclude, I think it's quite important that we don't confuse cyclical changes with structural changes. So we've went through a period of a very weak economy on a cyclical basis. As I said, the commodity prices and the interest rates, those are cyclical things. They go up and they go down again. And I think a lot of people confused the cyclical downturn with structural changes in the economy and concluded, therefore, that we are basically on the road to a failed state. I think the global environment currently is quite supportive, and that is important because South Africa has never managed sustained periods of economic growth without a supportive external environment. That's just not in our DNA. We need the rest of the world to play ball. And I think we have made important progress in terms of fixing some of the political policy and governance issues. And that is also very important. So I don't think we are a failed state. I don't think we're on our way to becoming a failed state. I think that interaction between the state and society remains strong. I think the institutions of society remain strong. The judiciary, the central bank, the strong financial system, free press, a very, very noisy and very active citizenry. We are not, unfortunately, going to be the next Korea or the next Singapore. There's nothing about our makeup or our government policies at this stage that tells us that we are going to enter a period of very rapid economic growth, and that will completely transform the economy, unfortunately. But we are also not going to be the next Zimbabwe or the next Venezuela. So as investors, what we need to do then is to make sure that we take part in cyclical opportunities and take part in valuation opportunities as they present themselves. And I think currently in the South African market, clearly that is where the big opportunities are relative to global valuations. So I hope that I've given you something to think about and hopefully given you some reason to be slightly less pessimistic about the future of our country. And hopefully we can avoid making emotional investment decisions.